Good morning, everyone. How's it going? Hope you're having a great Monday. This is going to be a exciting week. We're probably going to see a lot of volatility. And as I was noting over the last week or so, we have more risk to the downside than to the upside. This S&P 500, we are nearing all-time highs, but if we give ourselves a little bit of wiggle room, we can say that this is basically the same level as that, and this is almost the same level as this. So we are looking at what market technicians or chart analysts would say is a triple top. What that means for us really is that there's a lot of resistance here. We came to this level several times over the last few months, and we were just never able to get over it. So it's going to take a pretty big catalyst for us to move upwards in this market. That catalyst could come in the form of rate cuts, but there's a lot more room for the Fed to mess it up than to actually get it so perfectly right. Basically, they would need to get it so exact and meet everyone in the market's expectations in order for us to move higher. But if they mess any single thing up, then we'll start to move lower. It's just a matter of how fast the move or how extreme is that move going to be. Chances are, it doesn't matter if we get no rate cut, or a 50 basis point rate cut, or a 25 basis point rate cut. Chances are that we're probably going to head down, and we're starting to see that this morning. We just have a limited upside. So when we looked at momentum, or if we look at momentum, we'll see a very similar story develop. 90-day highs, 399. Remember, if we get over 400, that's pretty much it. That's time for a pullback. And we only had 10 or 11 90-day lows. So this is an indication that we're basically, this market is ready to pull back. It is going to take a really big catalyst for us to move higher and continue. And it would still be limited because of that momentum. That momentum will just go even more extreme, and we are just going to have a pullback from a higher level rather than where we are right now. So no matter how we spin it, it seems very unlikely that we will get a significant upside move. Because of that, and because of the volatility that we have in the markets, the potential for huge volatility, actually, we'll go into that for just a moment, or in just a moment. But the best thing, in my opinion, right now is to go flat, meaning that you have no positions, or you neutralize your portfolio. You have longs and shorts that balance each other out very, very well with high correlation, so that if one goes up, the other one goes up. If one goes down, the other goes down, but you'll profit in opposite directions. And that way you can capture, if it's an outsized move, you can still capture some profit. But if it's not an outsized move, then you're relatively balanced, or you might lose just a tiny bit. So that way your portfolio is protected. And then we can look for tail risk trades to the downside, or high reward risk ratio trades to the downside, because there's just so much more potential for us to move downwards. So
I'm sorry,
what was
but
I
there
talking
is
about
some,
earlier about the volatility? If we look at our CME
there's another
Fed
conversation
Watch
in the
tool,
background.
something really interesting happened over the weekend. I need this to reload. Okay, over the weekend, this became 50-50. Now today we're at 57.43. You can see that earlier this morning it was 63.37. So we have a lot of expectation of a rate cut, 50 basis point rate cut building up beyond now 50%, which is crazy, crazy levels. The Fed does not cut 50 basis points at a time unless there's an emergency. So unless there's something they're not telling us, then there's no reason for that 50 basis point rate cut. Also, since we started to expect that rate cut, look what happened. That 50 last week, we were at 13%. Let me get that back up. A week ago, do we have a week ago? Okay, it's showing 30.70. But if we look 2 days later, so on Wednesday, this was 13.87. So since last Wednesday, what happened? This happened. But even if we look a week ago from since last Monday, this happened. This surge movement happened. And that was going from 30% up to 57%. So if we don't get a 50 basis point rate cut, if we only get a 25 basis point rate cut, right now more of the market is going to be disappointed and positioned incorrectly than is positioned correctly, which means we are going to start retracing this movement. We're just going to undo whatever we did. And if people are really upset and get emotional about it, then we are going to more than undo whatever we just did. And in that case, we would be making a lower low, or at the very least, matching the low right here. And that's not a great sign for the markets. That would be interpreted as weakness, and bulls will really start to worry about their positions. And once they start dumping their positions, then we'll start moving to the downside. So everything that I've been saying is basically there's just so much more risk to the downside. That doesn't mean that we want to make our portfolios short. That doesn't mean that we just want to short everything. It means that we neutralize our position because there is still potential for movement higher. And so we're uncertain. We don't know exactly what the Fed's going to do. And we don't know exactly, even if we knew exactly what the Fed was going to do, we don't know exactly what the market reaction to it is because there's so many people that are positioned differently. 25 basis points, 57 basis points. What if we get no rate cut? There's just too many ways that people could be positioned. So we want to just neutralize. And then since we do have a higher probability of moving downwards, then we just take small allocations. We risk small, very acceptable amounts of money that if we lost all of it, we wouldn't care. It wouldn't affect our portfolios. It wouldn't affect our lives. But they have the potential of greatly profiting if we do move downwards. So that's what I'll be looking for today, tomorrow. That's what we'll be focusing on. Let's take a look at how the sectors are doing this morning. And we can see that we are a little bit biased to the downside in terms of most of the sectors. The S&P 500 has sold off since this morning. And right now, the best performing thing is the TLT bonds. So that's definitely a flight to safety. If we are expecting rate cuts, then we expect bonds to go up. So that's kind of in line. But right now, since this is such a mild movement, it is more of a flight to safety right now. And then this one is XLU. We've got, I'm not sure which this one, oh, clicking on the wrong thing. Or XLK, that's interesting, and XLP. So XLU, XLP are our usual suspects when there's uncertainty in the markets over the last few weeks. So, but what's interesting is that our XLK is moving up as well. Take a quick look at that. Yeah, it's really not. It's down quite a bit. It's just that since the open, XLK is just doing slightly better than the S&P 500. It's at critical levels. If it breaks below these moving averages, then we're heading lower. And it looks like we're definitely in a downtrend. So we hit resistance on Friday and we're pulling back from it. So I wouldn't go gung ho on XLK. Plus, it's one of the most at-risk sectors for the Fed decision. So I would avoid XLK. If anything, if you need to be long for whatever reason, XLU, XLP, just stay very conservative, stay very safe this week. And we'll just take a quick look at the S&P 500, what it's doing. See, choppy, pretty choppy. Right now, we are definitely look like this market wants to go a little bit lower, but I wouldn't expect huge movement ahead of the rate cut decision. There's going to be a lot of institutions that are keeping most of their money out until we get clarity on the decision. What will happen after the decision is most likely we'll get a lot of volatility, a lot of movement immediately after, and then starting the next session, you'll see that volatility start to collapse because we'll have certainty in the market. So when we look at VIX, we've got VIX at 17.46. what we can expect is 1 or 2 days after the rate cut decision, so basically Thursday or Friday, we can expect VIX to start moving lower because that volatility or the uncertainty is taken away. The major thing that people are not super certain, even though we're basically 100% certain that we're going to cut, we don't know how much. There's still uncertainty. After the event, also uncertainty surrounding that event goes away. So most likely we will see VIX come down. The question is, will it come down below 15 and start to feel like more stable? Or are we still going to be above 15, be elevated? Because for so long, our normal was below 15. Normal, see all of this? This is heightened, but we never stayed up above 15 for extended period of time before June of 2023. For most part, this was the normal level, which was interesting because that was pre-COVID levels. Or is COVID? Yeah, pre-COVID levels. So after the rate cut decision, we want to see if we come back down here or we stay above the 15 and stay 15 to 20 region. Or does all hell break loose and people start fearing recession and start going bear, then we would definitely spike up. So we'll watch VIX very carefully during and the rate cut decision and the couple days afterwards. So for today and tomorrow, personally, I'm just going to be flattening or neutralizing all my portfolios and looking for those tail risk trades. If I find any really juicy ones, I'll be sure to let you guys know. Okay, so today, don't expect a huge range in the S&P movement. I would say 564 at the extremes, 564 to 558. But if we look at that on a grander scheme of things, 564 is just near the all-time high over here. It's not that much higher from where we are, and then 558 is just down here. It's not a big deal. 558 4. Okay, so it wouldn't be a huge amount of movement. Spend time evaluating your portfolios, get prepared for that rate cut decision.